Well, welcome everyone to today's webinar titled Treasury Roadmap, addressing 2026 ACH fraud rule changes that impact your company. Our speakers for today are Taylor Nemeth, VP Product at PaymentWorks, Mark Dixon, Senior Consultant at Nacha Consulting Services, and Craig Jeffery, Founder and Managing Partner of Strategic Treasurer. Welcome, Taylor, Mark, and Craig, and I now turn the presentation over to you.
Thank you, Brian. Appreciate the intro. That was excellent. Taylor and Mark, good to present with you today.
Likewise.
Well,
Thank you.
I do want to ask just a couple of questions. Context matters. Before we get into our agenda, context matters in any discussion, and that is certainly the case when we're talking about fraud. So maybe I'll start with you, Taylor. Could you just briefly explain what PaymentWorks does and how that's relevant to the discussion today on fraud? And then I'll jump over to Mark.
Sure thing. Thanks, Craig, and thanks everybody for joining. I'm very excited to be speaking with Craig and Mark from Nacha Consulting about the upcoming rule changes in 2026. My name is Taylor Nemeth. I am the VP of Product here at PaymentWorks. Honored to be able to represent our company and the insights we've collected over the last decade or so of being in business. To introduce ourselves, PaymentWorks is a business identity platform for commercial payments. So our customers use us primarily to onboard their vendors into the ERP, create a payable strategy, and optimize things like virtual card or early payment solutions. But most relevant today is we de-risk the fraud problem associated with ACH payments. So we'll be focusing on that topic quite a bit. And we believe, our product is built to meet or exceed the level of compliance that Nacha will be speaking about today. Quickly, a little bit about us. We have about 1.5 million payees on our network. We onboard about 35,000 or so every month. The stat that we're most proud of is the fact that we've stopped roughly 200 million in attempted fraudulent transactions. And lastly, we're partnered with some of the world's foremost financial institutions, Wells Fargo, US Bank, JP Morgan, PNC. But in particular, I want to call out Chubb, who's an insurance company and has kind of been our partner in crime here since day one with their thought leadership, and has allowed us to offer indemnification against these types of losses. So that's us in a nutshell. I'll pass it over to Mark, I think.
Yeah, excellent. Thanks. And so, Mark, what's Nacha? I know there's Nacha, there's ACH. Could you give the quick run through on that?
Yeah, absolutely, Craig. So Mark Dixon, I'm a senior consultant with Nacha, and Nacha has a group within it called Nacha Consulting, which is who I'm representing today. Nacha is the governing body for the ACH network. So we are not an operator on the network. We actually oversee the network. So we establish the rules and the governance by which the network is operated for all industry participants. We also engage the industry quite a bit in making sure that we figure out what the challenges and problems are so that we can address the network and make sure that it's optimized for all industry participants. So part of that involves engaging from a risk management perspective. We have a risk management advisory group called RMAG, and actually some of the rule changes that went into effect that we're going to be talking about stemmed from work on their part. They had identified some of the credit push fraud scenarios. These are industry participants, financial institutions, technology companies, different folks that are out there working in payments. And they had determined that there was a shift into these credit push fraud scenarios. Those trends resulted in us putting out resources and information related to how it was impacting payments holistically. And then from there, we actually made rule changes that are designed to impact the industry in a positive way to address this type of fraud scenario. And we'll talk about false pretenses, which is a big part of these credit push scenarios. From a Nacha Consulting perspective, we actually work with the industry to address how you can actually enact rule changes, how you can create risk management strategies, new product developments. So we actually engage with industry participants to figure out how do you actually figure out how you can play in this space.
Great. Thanks. A couple more words for people to put in their lexicon. The Nacha is the rule-making governing body, and then the operators are the ones that are the payment rails, how they're moving. So excellent. Thank you both for that. But let's get into our agenda. You see 6 boxes on the screen. I'll talk through those really briefly and we'll get into the content. So vendor fraud has been significant. It's growing. The criminals are more sophisticated. And this creates the challenge. Why are there rule changes? There's rule changes across multiple payment platforms. So you've seen that on the card platform. You've seen that on Swift with Swift CSP, and you see that in the Nacha domain, the Nacha rule. And the purpose is, of course, to protect all the participants and to protect the payment rail. So we'll see how some of these rule changes are coming about and why that's the case. As we move down to implications of those changes, the changes impact banks and also impact corporates. These changes matter. Both of them matter to corporates. One, to understand what the banks are going through, and then what your particular requirements are. That's always helpful for context. And fighting fraud through multiple layers, we'll get into that in detail, but that's a key security process, having multiple security layers and protecting those layers. You don't want any of those layers removed. So making sure each of those layers are strong and appropriate. And then we have the timeline, the time to compliance. There's deadlines coming up in the first quarter and second quarter in 2026. So we'll look at those. Then in the key takeaways, we have 3 key takeaways. We'll spread those out and share what you should leave with that you'll hear through the discussion, but also summarize that at the end. So let's get into the network, and I'm going to call on Mark first. So the ACH network grows. It's electronic. You might think of ACH as direct deposit payroll, vendor payments, having your account debited or to pay your mortgage. Maybe you could talk us through some of the key parts of this, Mark.
Yeah, so this slide is really meant to demonstrate the strength of the ACH network and the overall increases that we see year over year. At the bottom, I'll start with those. Those are our Q3 stats, and that shows you that in totality, we have 8.8 billion transactions that have passed across the network this year, with 4.9 billion being debits and 3.9 billion being credits. So we still favor debit origination activity over credit, but you can see that they're pretty close. It's close to 50% of activity is one or the other. The other piece that I wanted to call out here was the same-day ACH volume. And obviously, because we're in a session where we're kind of focused on the business payment space, that's kind of the lens that we're looking at it from. But if you look at same-day ACH volume, which is basically an ACH transaction with what we refer to as an effective entry date, which is the wish date for the settlement, that actually settles on that same business day. So it's a faster form of ACH. You'll see that quarter over quarter, we have pretty significant growth, both in the dollar amount of money that's moving across same-day ACH, in addition to the overall transactions themselves. And transaction volume itself was a little bit higher than dollar amount growth. But you'll still notice there that compared respectively to overall ACH transactions, same-day ACH is only a percentage of that. A lot of ACH transactions still pass across what we would call next day or standard ACH. But the nice thing here is that we're seeing huge upticks in same-day ACH volume. When we kind of flip that to a fraud lens, that shows us that there's a little bit more of risk when we think about the credit push scenarios that are passing across the same-day ACH rail, because that transaction is happening and settling faster. Now, when we think about credit push fraud as a whole issue in payments across the board, it's not an ACH issue. So we addressed rule changes that we'll talk about later from a Nacha rules perspective, but any mechanism, any payment mechanism with the ability to push a credit transaction, which does include the instant payment rails, is also susceptible to any potential credit push fraud. But because so much of the volume is still occurring on the ACH network, our network definitely has its share of these transactions occurring, because we do continue to see solid growth and solid continued use of the ACH network.
Thanks, Mark. Couple things that I would just highlight. $16 trillion on the B2B side alone. The overall U.S. economy is about 27.5 trillion. So this is just the B2B portion of the ACH network. Obviously, transaction can occur multiple times, but that's a type of magnitude there. And just a refresher for those that don't live ACH all the time, a credit and a debit. If the originator issues a push or a sending of money, that's called a credit. And if the originator initiates a draw or a pull, that's called an ACH debit. So sometimes that's different from accounting, and we just like to keep everybody on their toes with those terms. So that brings us to poll question number 1, preparedness. So that should be on your screen. If you don't see it, you can look at the chat box and see Brian has put some messages there. So the question is, how prepared is your organization for the upcoming 2026 ACH fraud rule changes? We have all the answers. You can only select one. So pick the one that most closely represents where you are, and then hit submit. And that will be ideal to capture where the audience is today. After you've done that, in the chat box, Brian has pushed a couple links. Follow PaymentWorks on LinkedIn, Nacha, and Strategic Treasure. Go ahead and click those. Follow the organizations on LinkedIn. It's a great way to stay connected. It's pretty easy. And yeah, just a couple of clicks as long as you can access LinkedIn from your computer that you're viewing today's session. All right, so where are we? Let's see the results. So we have fully prepared 18%, somewhat prepared, but still evaluating gaps. Okay. And not aware. So this is pretty interesting. So I'll look and see who wants to take this one.
I don't mind.
Okay, go ahead, Mark.
So I'm actually glad to see this because one of the challenges, obviously, is that we're about 6 months out from needing to have the full industry not only aware, but fully ready to comply with this rule set. So it's good to see that the majority of folks on this webinar are in some way aware and working towards that compliance. Now, in other sessions that I've done on this topic over the last 6 months, that's not always the case. Sometimes there's quite a few people that are not prepared or not aware at all. So it's good to see that the industry, at least the folks on this call, have some degree of awareness and are working towards that compliance, because there really isn't much time left.
Yeah, excellent. Great points. Yeah, I wonder how many people didn't show up because I don't think that applies to me. And so, so it's good stuff. Thanks everybody for responding. Thanks for your comments, Mark. And in the chat box, if we have 150 people type the word PaymentWorks in the chat box, we'll send you all the poll results. So as long as you get most of the letters right, we'll be good. But just type in PaymentWorks. And thanks for your engagement during today's content and today's webinar. Mark, I'm sorry, Taylor, I'll bring you back in on this one. So push payment fraud, this is where payments are sent out. Can you talk us through the key issues? We can see on the slide, it says international scope. AI is leveraging a tool for criminals, and cyber defenses don't necessarily stop the people issues. Can you talk us through this?
Absolutely. So I think most of us, Craig, are aware at this point that this vendor impersonation fraud resulting in misdirected payments to a fraudster is a really big problem. It has been for quite some time. We used to have the obligatory charts that show it going up. You can see the one here on the left, 79% of folks who responded to this survey have had a fraud attempt. I think the other 21% either don't know or maybe not disclosing it. It's a big problem, a big number. But rather than giving you all some of the statistics that you've probably heard, because this problem is presenting quite a bit at conferences and webinars, we wanted to share some trends that we're seeing and how these impersonations are unfolding. So last month, or a couple months ago now, one of my colleagues was able to present with financial crimes and cyber crimes detective who is really at the forefront of seeing these sort of scams unfold. And what he was telling us is that the biggest change that he's seeing right now is in international scope is becoming clear. And so he was there to kind of eliminate this notion that these scams are some guy in a hoodie in their basement, which it might be. But more often that we're seeing, it's really an organized crime syndicate that is behind the attempt. He actually gave an example of a recent case where everything was in Chinese, but he traced it back to Nigeria. And so he's seeing a global cooperation between crime syndicates even, which is certainly frightening. So please think about this, and then think about, the person you have sitting at your vendor desk defending against that. You can see it's certainly challenging. The next trend is one we hear about. However, when you connect to the first trend, you can start to really see the scope of the problem. So the deepfakes aren't really the scary part of this AI component, the second piece I'm speaking about here. The scary part is more that is scary, I should say. But the part that we've noticed is the speed and the volume that these scams can be perpetrated, right? And so when I first started talking about these social engineering scams, it was largely a lot of construction vendors being impersonated, to a government agency or higher education institution. And they were targeted because those things are very public. They make newspapers. We're building a new wing of a hospital, that sort of thing. But now these scammers can evolve and reproduce these things rapidly. And so really no one is off limits, so to speak. At PaymentWorks, in the past year, just to give you an idea, we've stopped an $11 million fraud, and we've stopped a $1,400 fraud. So big dollars and small dollars, and everything in between. So no size of an organization or transaction is really immune to these because of the volume that AI allows our scammers to pump out. Next up, there's been many improvements we've seen in cyber defenses that have hardened your network so folks can't break in and try to impersonate from the inside. But fraudsters still have quotas to meet, believe it or not. So all they're really doing is funneling all of the efforts towards the weakest parts of your process, which is actually not your technology, but it's the humans. It's a person. We had a prospect come to us in the past couple of weeks who reported that it was now a daily problem for their IT folks. So every day they were noticing these scam attempts coming at them, and they can't do their regular jobs. All they're doing is consistently fighting scams. And then the last piece here, just food for thought for everybody listening. About 40% of the frauds that we see often trend towards the end of the week on Fridays. And so the detective that we presented with pointed out that fraudsters love Fridays, not just because people are in a hurry, because you might not notice until, say, Tuesday that you made a mistake. And so there's time for the money to be moved or things to be not uncovered during that time. So those are, Craig, those are the trends that we're kind of seeing that we wanted to share. All scary, but it's growing in terms of scope and speed as a whole.
Yeah, so staff training is essential for being on webinars like this, or having specific payment security training matters. Taylor, this is a pretty chart. Lots of forms here. Maybe talk through the messaging on this slide.
Sure. So whenever I tell my friends and family, what we do, or what the company PaymentWorks does, I talk about these vendor forms, and a quick Google search, you can look up some of the biggest organizations on the planet who have these PDF forms that vendors are filling out, a vendor packet that they either mail physically or email. And just to highlight, the reason these are up is because if you're in the audience and your vendor onboarding or change management process as it relates to payment credentials involves a PDF or a paper form like this, our view on it kind of is you're not bringing a knife to a gunfight. You're sort of waving a white flag at that point. And so if you think about the first trend, this international scope and organized crime syndicate, and think about your first point of onboarding being something that has very little defenses to it, a human working with a PDF form, it becomes very challenging to manage the risk associated with that.
So, false pretenses, the spoofing, synthetic identities, everything that's meant to trick people, seem to fall under this rule amendment. Mark, could you talk us through what do you mean by false pretenses? How is Nacha looking at this?
So this was a way for us to really quantify the credit push scenarios and compare them against like traditional fraud scenarios, which would have been more related to a debit pull type of transaction. So this really sets the stage behind what we're talking about from a credit push perspective. So the rule says the inducement of a payment by a person. Now, a person could be an organization or involved in an organization. So it's not necessarily talking about an individual to an individual account, although it could be a person-to-person scenario. But that person is misrepresenting their own identity. So they're pretending to be somebody that they're not. They're pretending the person's association with or authority to act on or behalf of another person. So they're claiming to have some degree of authority. So, like for the purposes of a vendor payment, I'm the person that can tell you where to route those vendor payments in the future to. And then the ownership of an account to be credited. So I'm misrepresenting the fact that I even have access or rights to the account that I want you to send to. So the goal behind this is that the person is misrepresenting in a way to get you to route funds to a place that you shouldn't because they're doing these different things. They're misrepresenting who they are, who they're involved with, and their authority to provide you that information. And that does, as the bottom of the slide talks about, ties into these other scenarios, such as the business email compromise scenarios, the vendor impersonation, payroll, and other payee impersonations, because this rule is broad. So it does address anything from a credit push scenario on the origination side, where you're actually originating these transactions. It actually is broad enough to include both debits and credits. But for the purposes of false pretenses and credit push scenarios, it's really that misrepresentation of my authority to tell you where to route the funds in the future.
Yeah, thanks for talking us through the details on that. So this particular graphic, Mark, has 3 boxes: fraud monitoring, expansion of ODFI, and RDFI. So I'll just do a quick intro on RDFI. Depository financial institution in Nacha language is your bank. Receiving is the one who, well, the originating one is if you send an ACH payment or initiate a debit to receive money, that's the bank. Your originating depository financial institution, the one that starts the transaction, and your counterparty deals with their bank, which is the receiving depository financial institution. So that's the language of the ACH network. But can you talk us through what we should understand here in this framework?
Yeah, and where this graphic came from, originally we had designed this as a puzzle piece, different puzzles fitting together. So the reason for that is that we knew that this was not an issue that one participant related to the payment ecosystem could solve for. So obviously today we're talking a lot about the fraud monitoring and the requirements on the originating parties, which includes the actual originator, the business making that payment or creating it, the third parties involved, which could be technology companies, and then the ultimate financial institution that the funds are routing through. That's a big piece of this. And that's a lot of what we're going to talk about. But it's also important, I think, for the industry to realize that we didn't do this in a silo. We didn't say the originating parties are the only ones that need to have a stake here. We recognize that the receiving institution, who has the customer that's receiving those funds, could be a party to that fraud scenario or that false pretenses scenario. They're in a position to recognize what's normal for their customer or their receiver in ACH speak. So we did put requirements in there for them to look at those transactions, identify, and work with the other participants to recover. In addition, we also did an expansion of what we call a request for return. Now, the warranties in ACH don't allow a recall mechanism on the originating side. There are reversals, but in fraud scenarios, reversals are not applicable. So there is not a mechanism to claw back money or claw back transactions once you've originated them and they've gone out into the network. But what we did do was create an expansion of an ask for the receiving institution to return those if possible. So that also supports the recovery mechanisms and the cooperation amongst the parties. And lastly, we did a standardized descriptions, which kind of sits on the top of this puzzle. So those are to better characterize payroll and e-commerce transactions so that when receiving institutions are screening and monitoring, they can potentially look at triggers related to mismatches associated with transaction purpose versus what's actually happening on the receiving side.
Mark, that was a great explanation. You know, as you talk through it, the change was, you know, you could see the ODFI has more responsibilities now than they had before, but what's different is the RDFI was, I don't know if you call it, a little bit more passive. There was less responsibility. And so if you're looking at a payment network, you're trying to protect the entire payment rail, both parties need to act on that. So this establishes some of those rules. I liked how you described that. So what are some of those rules? We got the who, the when, and the what. And there's a couple more terms to hear. So maybe you could explain some of those as well. And there's also one of the things that's interesting, I'd like people to listen to as Mark talks through this, is to, the materiality aspect comes to play with some of the volumes, right? And so we've seen that across the board. Every payment rail starts to put in materiality, what level of care is required, and then those levels shift down over a year. So there might be a level that's above what you're doing in 2026, but at some point, you'll have to follow these rules. So even if they don't apply to you immediately, pay attention. So Mark, if you talk us through this.
Yeah. So this is the originating side of the rule change. So anybody involved in the origination process. So if you're a business that's originating payments, if you're a technology company that's involved in the generation of those in some way, or if you're the financial institution that's transmitting them, you all are required to, in a two-phased approach, which is as of March 20th of next year, for anybody with origination volume of 6 million or greater as of 2023. And then for June 19th, which is actually June 22nd because of Juneteenth, all other parties that are not falling into that 6 million or greater bucket will have to comply by then. And what you have to do is establish what we refer to as a risk-based process and procedure that is reasonably intended to identify ACH entries initiated due to fraud or false pretenses. It's both buckets. Fraud, think of it as the debit pulls. False pretenses, think of it as the credit push. Now, I know a lot of folks, when they hear this, they go, well, that's very vague. So risk-based processes tells me that I have to establish something, but I don't necessarily know what that means. I'll talk a little bit more about what our guidance is on this front. But what risk-based processes means is it allows the industry a degree of flexibility in how it determines what is appropriate for its own organization. So at Nacha, when we develop rules, we are not going to prescribe very specific things other than what we think is appropriate from an industry perspective, because we recognize that the industry needs a degree of flexibility to be able to figure out what's appropriate, especially from a risk management perspective, because every organization is very different and unique. So what that means is that your higher risk transactions or things that you deem to be higher risk for your organizations may not be the same as what your peers think, because the transaction risks may be different, the controls around it may look different. So what could be a scenario that's high risk for you may be a lower risk scenario for somebody else. So that's why it's very important that every organization establish something that is appropriate to them. These do need to be formalized, so you do need to have some sort of formalized process where you're saying this is how we identify transactions that may have been initiated due to fraud or false pretenses, and this is what we do when that occurs. But again, you do have flexibility in the way that you enact that, and in future slides, we'll go into a little bit more detail into what we think should be included in that process.
Yeah, thanks for talking through that. When you talked about it's a little vague, it's a little bit open to interpretation. But one of the things we do see over time is what was maybe a bit paranoid for security, 2 years ago is like minimal corporate standards today, and maybe not sufficient for tomorrow. So I like the fact that it is flexible because the risk changes from year to year. So that sort of bakes it in. All right, Mark, we're going to weigh in on you again to cover another slide on what are the actions that are being recommended by Nacha and by others in the industry.
Yes, so this is where we're going to dive into a little bit more about what this can look like. So one thing to keep in mind is that we're not saying that a risk-based approach needs to include all monitoring of every single thing that you're doing. It wouldn't be reasonable for you to do that. It's just not scalable from an industry perspective. So one of the things that this rule really looks for you to do is to differentiate your higher risk and lower risk activity. So if you're doing a transaction to ABC company and nothing has changed and everything is, you've been making these payments for 10 years. No, there's no real fluctuations. The baseline of activity hasn't changed. The payments are either between 10 and 15,000, and that's pretty much standard. That's probably falling into a lower risk transaction bucket. But something else that is either a newer payee or something that has changed significantly from normal behavior or normal activity, or a new approval mechanism, something like that, that could have triggered a change, that likely would fall into a higher risk bucket, and you might want to look at that closer. So those are just examples, but the idea here is that you're going to figure that out within your organization. What do we as an organization deem to be high risk? What do we deem to be low risk? Then you want to have processes around the monitoring, and ideally these should be monitored before and identified before you transmit them out through your financial institution. You'll note in the rule itself, it doesn't say that. Because the more prescriptive we are with that, there are also other considerations and legal ramifications from that. So the idea is that we want the industry to be proactive versus reactive, but we do again give you a degree of flexibility for this. But when you're monitoring transactions, part of the key aspect of that is to establish a baseline of normal that you can compare anomalous activity to. So when something happens that is outside of what your expected outcomes are, that's where you should be triggering and identifying those. Part of the process then would include flagging the transaction and figuring out what the follow-up to that's going to look like. So are you going to reach out to that payee and try and figure out what happened? Are you going to look into what were the authorization processes? What were the triggers associated with that? And why is it that you think that there's something that might be potentially wrong? And maybe you figure out that, no, it's fine. We can go ahead and process it. But the goal here is that you flagged it so that you can figure out, do we need to stop it, or do we need to take further action? You can, again, do this through communication with the receiver. You can look at other internal monitoring teams to address that. And you can also use account validation methods that would help you get a degree of comfort around the idea that that receiving account is the account that you're expecting or anticipating to send funds to. Now, we don't say that you have to use technology partners when you're doing any of these processes. But services like PaymentWorks, which by the way is a Nacha preferred partner, which means that they've gone through a vetting process with us and that they're considered one of the providers of these services that Nacha recognizes as providing quality service in the industry. That gives you a degree of scalability. So I would say that when you're lower volume, and Taylor will talk about this too, when you're lower volume, being able to do things more manually is manageable. But as you scale up and have more activity, it can be harder to do that without automating some of the solutions, especially when we think about the fact that fraudsters are also leveraging those types of tools on their side. The last thing I'm just going to say with this is that this is not a set it and forget it process either. Nacha's expectation and what the rule states is that this needs to be looked at as on an annual basis and adjusted to address for evolving threats and fraud landscape. So while you can definitely meet the requirement by starting out and building this and doing your framework, you need to make sure that this is looked at on a regular basis.
All right. Thanks for stepping through that. I know there's been a number of questions and comments. We've tried to answer some of those in context. Now we're at our second poll question. This is an all that applies, so it's multiple choice. Which areas of your payment process present the greatest fraud risk today? Vendor onboarding, bank account changes, payment initiation and approval workflows, third-party service provider connections, incoming ACH credits or return handling, other or unsure. Go ahead and answer that and click submit when you're done. I'm told we needed 39 more PaymentWorks in the chat box to complete the requirement of 150 people typing PaymentWorks. We'll send all of those responses out in this deck where it says poll question now, and you get the deck after the webinar. It'll include the poll results. I love looking at that data, seeing what the responses were and how it's going on. So that's I can see a lot of people like data too. All right, so this one, Taylor, I'm going to be asking you for your comments once the sufficient number of poll results are shown. I may make a initial comment and then ask you to share your thoughts on it.
Sure.
Vendor onboarding bank account changes 65%. Okay, this is select all that applies, so the numbers can add up to more than 100. Well, this went in the exact order, right? Payment initiation, third party, incoming ACH credits, or return handling. Any initial thoughts on this that would be particularly useful to the audience?
No, this is about what we'd expect. I mean, we consider the fraud to occur on the top line. That's where the fraud is actually perpetrated, is during the change process. Somebody's misdirecting a credential or misrepresenting themselves to give you a credential. It doesn't actually get, the losses don't occur till that second one, payment initiation and approval workflow. So if you combine the two of those, you get a pretty big number. And I think that's about what we would expect, Craig. The other ones, I'd certainly be interested in learning more. The incoming ACH credits, I can understand that certainly from a receivable standpoint. A lot of suppliers are also the victim in this type of fraud. And then I'd be curious to learn a little bit more about the third-party service provider connection.
Yeah, excellent. So yeah, so that was great. I appreciate everybody answering the poll questions. That was fun. And we're gonna flip back to you, Mark, for this next one, the role of the bank. So if you're a corporation, you have certain responsibilities. If you're a bank, you have certain responsibilities and requirements. And if you're a bank, you're probably going to push some activity or some of these requirements down to your providers to make sure you can comply. Maybe you can talk us through the role of your bank.
Yeah, and I think I saw that we had a question come in about enforcement and how this is actually how it's evaluated as an industry, and I think this ties nicely into that. So one of the things to think about is that the ODFI, and this has not changed with these rule changes, is ultimately responsible for everything that gets transmitted out. So they're the originating financial institution. So they actually put out the warranties to the network around everything that they're transmitting. It's been properly authorized, formatted, and so forth. So because of that responsibility, they're actually the ones that audit themselves, them and the RDFIs. They get audited on their compliance with Nacha rules to make sure that they're meeting those responsibilities. Now, how a banking partner is going to address its responsibility, because when it allows originators or other companies that take on even more responsibility, such as what we call a third-party sender, which means that we have originators even further downstream, they cover themselves through an ACH origination agreement, which is going to drive your responsibility as a business that's originating. One key aspect that's always in this, and it has to be, is that it says that the originator is bound to the Nacha operating rules and the compliance requirements that are outlined in them. So that binds the business to making sure that they're doing the appropriate practices as defined by Nacha. Now, your banking partner can also drive additional requirements as well. So just because we say something specific in the rules doesn't mean that your banking partner can't further enhance that or be much more prescriptive in what their requirements are, because that's a legal agreement between you and them. So that's something that you agree between the two parties. So a big part of the compliance related to these new rules is to make sure that you're engaging with your banking partner to understand what their expectations are of you. Do they want to see that you've done a formal risk assessment? Do they want to see that you have formal program documentation in place? Do they want to review policies and procedures? Do they want to have a meeting with you to walk through your technology and how you're complying with these rule requirements? They're allowed to do that through their agreement with you and as part of the Nacha operating rules. So you want to make sure you get their feedback into what their expectations are. You want to make sure they're looking at what your current process is or your proposed process, and that you get their blessing on that. And then if you need to make adjustments to that program or what you're doing today, you'll want to ensure that you're meeting not only the Nacha rule requirement side of things, but you're also meeting this banking partner's expectations. This is a big part of the compliance requirements. The financial institutions are the ones ultimately responsible for meeting these requirements under the rules, and then they allocate that responsibility downstream and they manage their originator relationships directly.
That makes sense. If you're looking for your bank to charge you less than 25 cents an item for an ACH, they don't want to take on a huge amount of risk if you're not protecting things. So all that made great sense. Well, there's the overall policy or the framework that's required. What are the expectations, as well as the action items that are necessary to accomplish that, Taylor? Talk us through this workflow.
Absolutely. So the minimal requirement to meet this new Nacha rule, as you can read here, is to establish and implement a risk-based process and procedure reasonably intended to identify ACH entries initiated due to fraud. And just to boil that down, eliminate any confusion, speaking in practical terms, what this means is you're really going to have to do one of two things, or both. One is you can access a third-party data source through your bank or a non-bank partner, but a lot of folks are going through their banks these days to do lookups. However, it's only going to work maybe 50% of the time. So for the rest, you're either going to have to accept the risk, which we don't recommend, and most folks don't, or you have to make a phone call to the vendor to confirm banking, which is fraught with problems, but frankly, there's not really an alternative. And since in both cases you're relying on humans, you want to make sure you have a good process in place to ensure that the humans know what to do, but more importantly, what to do in the instances where there's an exception. As we all know, a process is really only as good as its ability to deal with the 10,000 exceptions, which I can promise you, as it relates to this, inevitably do occur. But let's dive into the difference between a policy and a process. So we work very closely with Chubb, as I mentioned earlier. And the lead underwriter in the crime business there, a guy named Chris Earhart, has some really strong views on this. So companies will call him to get, and his group, to get higher limits on social engineering insurance. Usually the limits for those off the shelf are quite low, maybe around 250,000 or somewhere around there, which, as we know, these are big dollar losses. So that really only gets you a little bit of coverage. They'll come to him looking for something higher, and he'll ask, do you have a policy to verify banking information? And of course, everyone comes back and he says yes. And he'll say, great, well, can you send me, your written procedures that are continuously updated, reviewed, tested, audited, et cetera? And almost invariably, they look at him with kind of a blank stare. And he says, okay, great. Once you put all that in place, we can talk about raising your limits. So according to the AFP survey last year, about 58% of organizations surveyed have documented procedures, which is fantastic. It's higher than I think we would have expected. However, just having them documented is not necessarily going to bring you into compliance with what Nacha is asking. Of those 58%, how many have tested it, reviewed it, created an auditable process, et cetera? And when you factor that in, you can imagine the number probably starts to shrink down a bit. So why is this important? Because it's all about the exceptions. So we all know every procedure is written for the happy path, right? Those cases where everything works perfectly, if this, then that, and it forks in a certain direction. But operational and financial controls are all about having written procedures and training the staff for the edge cases where the happy path just doesn't work. So for example, what happens if you can't verify a bank account on Friday and the vendor's screaming about not getting paid? It's a really important payment. Or, the vendor desk person who's trying to get a payment out, the AP clerk, who's trying to get a payment out that requires additional level approval and their manager's out for 2 weeks. How do you, if you're making phone calls and suppliers call you back, how do you confirm it's actually them when they're calling you back? How do you train new team members on the process? What if someone's out on vacation? These sort of things. So there's 100 different ways in which your process can fork in a direction that you don't have documented. And we know this because we have documented email and phone correspondence with payers and fraudsters to see how they operate. And we've seen all of these different edge cases unfold. So this is where processes break down. And unfortunately, the fraudsters know it and they prey on it. So yes, the base level requirement is to establish and implement, these risk-based process. But if you want to really protect your organization, you need to make sure they're periodically reviewed, tested, audited, and you have a significant level of control over them. Controls.
All right. I know there's a lot of questions coming in. We'll take what we can on those. But right now, if you turn your attention to the third poll question, impact of rule changes, which part of your organization will be most impacted by the 2026 ACH fraud rule change or changes? Select all that apply. So go ahead and select that and submit that. Give everybody a moment to do that. And we have enough responses for PaymentWorks. We're well over the 150, which is great. If either of you want to take any of the questions that are in the Q&A box or in the chat box, those are fine too. Some of them are a little bit lengthy. It'll take a lengthy response, but
there's one error about being kicked off ACH. I can answer that. So that's going to be, there's a few things that'll drive that. So the biggest part is going to be your agreement and your compliance with your financial institution partner. So if for some reason you were blatantly disregarding the rules or not doing what you were supposed to, it's possible they could terminate your access from the network. If Nacha got involved, we do have the potential of saying that somebody can't be an originator on the network. It would take a huge systemic issue for us to get to that point. Generally speaking, that enforcement would be at the financial institution level, and it would be driven by the fact that you didn't comply with the rule requirements and you probably caused them a rule violation.
great summary. So I think for time, I'll just make a comment on this one, right? Which ones are the key areas, AP and Treasury? The ones making the most payments. IT has some issues, vendor management, maybe at the setup point, and then bank relationships. So really appreciate the responses there. You'll all have this information in the deck when it's sent to you. But I'm going to turn back to you, Taylor, on vendor changes. We've got a nice pie chart that shows, and we've got a verification solution set to handle changes and vendor updates. Maybe you could talk us through this and why we've got this sort of Pareto distribution for effort for verification.
Will do. So it's really important when you're building your procedures to look at automation. When you consider the volumes of manual bank verifications your team is going to have to make, either by phone or the third-party lookup that I spoke about. This is where I think everybody, certainly if you're not in the vendor desk or accounts payable or wherever that sits, it's where a lot of folks underestimate sort of the sheer volume of changes to the vendor master file, which we call kind of vendoring events. So either setting up a new vendor or a change to vendor master record, that's the right half of that pie there. And all of our data indicates the following. If you have about 100 vendors in your vendor master, let's say during a 12-month period, about 16 of them are going to become inactive. 34 won't require any changes. 22% will be, or 22 will be new vendors, and 28 of your existing vendors will require a change. That's that purple part there. So that's 28% of your vendor master that is going to change something, whether it's a bank account or an address, tax status, and so forth. And so this 50% here on the right is what's referred to in security circles as sort of the fraud surface area. This is where fraudsters prey and why vendor desk people are so vulnerable. But if we play that out a bit more, that's about 50 vendor records that need to be verified. So in that example of 100. So 50% can be verified with a third-party service to verify bank account ownership, as I alluded to earlier, and about 50% are going to have to require a phone verification. And keep in mind, making phone calls is extremely time-consuming because these days in particular, it's extremely difficult to get someone on the phone. And if they're calling you back in most cases, how do you know the person you're talking to is not a fraudster? So it's the best option, outside of the automated third-party lookups, but it's very costly and very time-consuming to try to find a supplier, right? It's very easy for IBM. They have a switchboard, you can call them, Microsoft, Google, etc. It's very hard for small and medium businesses to find a number that's directly tied to that business. And there's tools out there that can do it, but they're expensive. And so phone calls are great, but I just want to make this point. You absolutely need to make sure you're talking to the right person. Otherwise, you're just verifying information with a fraudster. And, in the silly example I gave with 100 vendors, most companies don't have 100 vendors, certainly probably no one on this call. You have 10,000 vendors, right? So that's 2,500 phone calls a year, each of which requires 2 or 3 hours to get an answer when you kind of average it out in callbacks. And so who's going to make these calls? How do you know they're going to follow the formal written procedures that are reviewed and tested periodically? How do you know when that big payment inevitably goes out to one of these vendors that those processes that you outlined were actually in place? But again, kind of the biggest problem at all with respect to the chart on the right is third-party lookups are easy. They're quick, they're efficient. You can automate them. Phone verification is going to take up 90% of your time. And that's because the biggest question with phone verification is how do you know that the person you're talking to actually is they say they are? And that's where it gets a little scary.
All right. Now, Taylor, the automation is required, the ability to scale, or if you have whether you're scaling or not, you might have a certain volume of the regular turnover that exists. Maybe you could talk us through some of the key points in this graphic.
Sure. So, we believe automation is critical here. Mark alluded to it. This is where people, especially after my last slide, people might say, I'll just get a third-party service and do bank account ownership verification and make some phone calls and I'm good to go. In our experience, certainly with any sort of reasonable volume, we believe that couldn't be further from the truth. Unfortunately, there's no one solution, right? I wish there was a place where we could all go and just verify these bank accounts, and this would be a much better, a much smaller of a problem. But fighting fraud requires a combination of different technologies. And so, first is sort of, I'm going from the top left, kind of counterclockwise here. First is identity verification. So before you even do anything to sniff out fraud, you have to ensure that you know who you're paying and do some level of identity verification. You can't, in other words, you have to confirm that IBM is the intended recipient. This is their corporate address. This is their tax ID. They're not on any debarment list, sanction list, et cetera. And so you have to verify the legal entity which you're trying to pay, which again, for IBM, not so hard. For the thousands and thousands or millions of other businesses, it becomes a little more challenging. Number two on the top right is, if you have a service that can do this screening and analytics. So we often know it's fraud on our side, way before we even make a phone call or even looking at the data itself, just because fraudsters tend to do things that are abnormal or atypical. And so they're doing things like creating a burner phone to use for their multi-factor, or they're using an IP phone to receive that phone call, or they're spoofing an email domain that was just created yesterday, that sort of thing. And so, or they're switching around devices or bouncing around VPNs. There's all sorts of funky stuff that fraudsters will do that you can de-risk yourself significantly if you have a portal or process to collect these electronically. Having this kind of screening and analytics will cut your workload significantly. Third on the bottom right is account verification. So this is what I've spoken to about quite a bit. This is either a third-party lookup, which is fantastic, or you're on your own and you can make some phone calls, which I would recommend and certainly do work. And then lastly is the payment monitoring piece. So again, I think this one's critical, and one that we feel strongly about is if you're making a payment to somebody for $1.5 million, $2 million, $10 million for a big construction project or something of this sort, you really want to know that process you laid out has been confirmed or has been completed rather. And that's the scariest part, because that's where, as I mentioned earlier, that's where the loss is actually, or that's not where the fraud happens, but it's where the loss happens when you actually send that money out and it makes its way to the receiving bank. So I'll wrap up with this. It's not trivial, and Mark alluded to this earlier. At the end of the day, you have to ask yourself, is this something you want to do, or should we turn it over to a provider? And of course, we're a little biased here, but I'd be happy to share with you other folks in the industry who do similar things to what we do. There's a lot of them out there now, fortunately. But this is sort of becoming like where cybersecurity was maybe 20 years ago or so, where folks were building a lot of technologies in-house. Now they're starting to realize that if you really want to de-risk yourself, it's a really complex solution and a really complex problem that you're fighting against. So, you know, a lot of folks are kind of turning to managed services and people who can kind of do this on their behalf. But of course, that's up for every organization to decide.
Great, thanks, Taylor. Mark, can you hit the highlights of the timeline?
Yeah, so this is more meant to show you that the readiness for this should have already been at play. So we put these rules into effect in 2024 with effective dates in 2026 because we knew it was going to take the industry time to really respond. So I would look at the real high level pieces here. Make sure that you've done a gap assessment and identified the high risk versus low risk activity. Look at your processes and see how formalized they are. Look at the controls, make sure that you have effective controls in place, and again, tie back to your banking partner requirements. And then as you're looking to the future and moving into compliance moving forward, look at how you can make things better, how you can enhance, look at technology solutions that could potentially make things more scalable, but make sure that whatever you have in place is going to meet the core intent of the rule moving into next year, and that you have plans to evolve it over time.
Thank you. So this brings us to our final thoughts. We're going to go Taylor, Craig, and Mark.
Yeah, sure. I'll be somewhat brief here. I'm not sure exactly how much time we have left, but I think one of the final thoughts that three of us wanted to leave you with was start by determining scope of work. So look at the existing size of your supplier file, start to quantify, you know, how many changes you have. You know, don't just take my word for it. Look at how many changes you have, how many vendors you have, and start to quantify the level of effort that it would take to verify all these either through automated means or third-party lookup. Start to quantify the costs associated with it and that sort of thing. But start with an audit. Just look at where you're at, do some analysis, and then determine your strategy from there.
The second one about gathering key stakeholders, we saw from the list that Treasury, AP are two key components, usually payroll. There might be some other admin areas. Gather them together. The risk assessment process should look at what your exposure is, what are you required to comply with, what else do you need to do to tighten things up, and then look at the timeline that Mark stepped through. What's necessary, and then what resources you might need to use. And that brings us over to Mark.
Yeah, and I've mentioned this multiple times. Make sure that you understand what your financial institution partners' requirements are. What are they expecting of you? And what are they expecting for you to do over the next 6 months to 12 months? What do they want to see? Do they want to see a formalized program? Do they want to know what you're working on? Because what they expect of you is going to help inform how much resource you need to put into that, what further steps you need to take in the immediacy. So make sure you understand what those expectations are.
Excellent. Thank you, Mark and Taylor. And I'll turn it back over to Brian. Everyone, thanks for joining us for this content and participating in the polls and the Q&A and chat box.
Thank you, Craig. Thank you, Mark. Thank you, Taylor. And thank you, everyone, for joining us today. The CTP credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And to stay up to date on all things Treasury, be sure to check out the Treasury Update podcast by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.